All right. Hi, everyone. Welcome to this webinar today on AI and smart technology for optimizing payments and subscription retention. My name is Jeffrey Paletto. I'm the Director of Innovations here at FlexPay. I've been here at FlexPay for about 8 years or so now, and I manage some data scientists and data analysts where we build machine learning models to look at the problem of declined and failed payments and what can be done to recover them. So getting right into the problem, failed payments, what are they? So failed payments are any sort of payment that a merchant tries to make that doesn't end up going through. It can be for generally one of three reasons, either insufficient funds on the customer's part, the bank deciding to not let the transaction through, or some other technical reason. One subcategory that's really important that we try and focus on here is false declines. False declines are the transactions where a merchant tries to send a transaction over to the bank. The bank looks at it and analyzes it and isn't sure that it wants to pass it through. It's not going to say it's fraud or there's some other hard reason why the transaction can't go through, but the bank isn't comfortable letting it go through right now. That's generally called a false decline, and it's a problem for the industry, especially in card not present, because when a transaction is done card not present, it gets flagged by the banks as a riskier transaction off the bat. The real pain that merchants feel from this is that while banks are trying to avoid fraud and reduce fraud from the ecosystem, which in fairness, everyone in the industry is all for, banks tend to block one fraudulent transaction for every 8 or so legitimate transactions that could have gone through. It's a difficult problem for the industry, and we'll get into the problems why banks are getting caught up with that. But it is something that really hurts merchants, and there is steps that can be done to ameliorate that. But it's important to know what those reasons are, what's causing them, and how to be the best actor as a merchant in this ecosystem. So simply doing a Google search, if anyone of you wanted to do it for CNP declines, so CNP card not present, you'll see right away there's articles. The first articles that show up are what are false declines, what can be done to fix the problem, and how false declines lead to more losses than fraud. It's kind of shocking, but from a merchant's perspective, false declines, if you look at the amount of revenue lost for merchants due to false declines, it ends up being more than all of the fraud losses that they suffered from chargebacks. It's a very prevalent problem in the industry, but one that isn't talked about nearly enough. And so I'm going to try and highlight what is going on with that here today. So what are the impacts of false declines? Well, first and foremost, you're going to lose customers. It's an involuntary increase in customer churn. The customer isn't going to know what happened with their service. Why is it that I lost this recurring service that I was subscribed to from one day to the other? Well, sometimes the credit card not going through is the problem right there. So there's an emotional reaction due to the credit card failure. The customer suddenly feels like, did I do something wrong? Am I over my limit? Did something happen? Is there fraud on my account? I don't know. It's certainly a negative brand experience. So either I have the problem, or maybe you as the merchant have the problem. Why is it that I can't pay you? Why are you not letting that go through properly? The brand becomes associated with credit card issues. Well, maybe I don't want to sign up to your service anymore. Maybe I don't trust what's going on here. It's unusual that I'm seeing credit card declines as a customer, and it seems to be only through you. And also it forces a decision to continue with the subscription or not. If you as a merchant can't get the money from the customer, well, the customer is going to move on. They might try and pass a different credit card or find some other way to get through, but that's certainly not the position that any merchant wants to find themselves in, where they are hoping that the customer makes a decision and acts to continue the subscription on their own. The estimates for false declines in the US alone are around $500 billion for 2021. That's an absolutely astounding number. It's really frustrating for merchants when they see so many of their transactions getting blocked, generally because of, like I said, false declines, generally because the transaction just isn't going through because the bank isn't sure if it wants to let it through or not. So what are the root causes for these failed payments? Well, like I said, there's really three reasons why a transaction is not going to go through. It's either going to be insufficient funds, the bank isn't sure it wants to let it through, or some other technical reason. Those reasons generally get split up into what are called soft declines and hard declines. Soft declines are ones where the bank doesn't want to let it through, but at the same time, it's not so sure that the real reason behind the decline. It's not so sure it doesn't want to see it again. It's not comfortable letting it go through right now. And a hard decline, on the other hand, is one where the bank is absolutely certain the transaction will never go through. Let's look at some examples here. So soft declines, some are related to the customer themselves. So insufficient funds can generally be about a quarter of the declines that a merchant might see, sometimes even as high as a third. But bank declines are the vast majority of most merchants' decline reasons. So that's either bank decline or do not honor or refer to card issuer. It goes by many different names, but effectively the reason is the same. So what ends up happening is every transaction that goes through to the bank gets a fraud score attached to it. Whether it's the bank doing it themselves or an issuer processor doing it on behalf of the bank will always see a score for it. If the score is low enough, they'll let it pass through just normally. If it's very high, well, then that's an easy decision as well. Just block it because it's very likely to be fraud. But there's a middle band where a bank isn't so sure that it's fraud, but isn't so sure that it's happy to let it go through. And so it falls into this soft decline pool. Again, that's a very frustrating band to be in because it means that the bank isn't sure. It doesn't want to take a hard stance on it. It lets you try it again, though. And maybe next time, if you present it better to the bank, they will let it through. Conversely, hard declines are transactions that the bank knows for sure it doesn't ever want to see again for some reasons here, like restricted card or expired card. Generally, they're a low percentage of the overall volume of transactions that a merchant will send through, but it happens, and those are transactions that effectively have no hope of recovery. An expired card will never turn into an approval if you send it through again. A transaction not permitted to cardholder will generally never turn into an approval if you try and send it through again, and so it shouldn't be a focus of anyone's recovery efforts. It should always be on the soft declines on how to recover those insufficient funds and those bank decline reasons. So why are there these problems? Why is it that banks can't make the right decision all of the time? Well, there's a systematic problem in the industry. It's not caused by the customers, and it's not really caused by the merchants either. It's how the ecosystem was set up to begin with. The banking system was designed in such a way that it limits how long banks and issuer processors have to make decisions. Most transactions, even these days, are done with someone holding a card, putting it into a terminal, usually putting in a PIN, and that getting processed as a card-present transaction. That's how the banking system was initially designed. Consequently, banks don't always have a lot of time to make a decision on whether or not this transaction is fraud and whether or not they want to let it go through. If they took 5 seconds to make a decision, well, they would make a more informed decision. They could probably look at the entire customer history and get a really good idea of, is this in or out of the customer's normal buying habits? But they don't have that long. They probably don't even have a tenth that long. They might have 1 or 2 or 300 milliseconds to make a decision. And that really limits the analyses that a bank can do live with the transaction. Similarly, they're limited in how much information is sent to them. Simply the rails that a bank has to receive information don't have all of the information that merchants do. If you as a merchant know that this is the 10th month that your customer is paying for their subscription service, well, the odds that that is a fraudulent transaction is basically zero at that point. Almost no one that is at their 10th month or 15th month paying for their subscription is doing so with a frauded card. In fairness, it's not entirely zero, but it's almost zero. But the problem is banks don't always get that information. There's just no rails to send it over to them. So a bank might see that this is a recurring transaction. They might even see that this is a certain billing address and a certain shipping address, but they might not see the IP address. They might not see the email address. They don't have the information that this is, again, the 10th month that this customer is paying, unless they're able to look at the entire history of that customer making purchases. So if they had that information, they could make a better decision. But for the most part, they just don't have access to it. And similarly, they are limited in their tolerance for risk. Certainly, everyone in this entire ecosystem, from the merchants to the banks, all realize that fraud is still too prevalent in our ecosystem and far too costly. For banks, generally they have insurance to protect themselves against the liability of fraud, but of course their premiums will adjust based on how much fraud is actually getting allowed through. So there's a high incentive for all banks to increase that fraud score just a little bit to allow in less transactions, allow less fraud, but when you do that, it allows less legitimate transactions through as well. So while some banks are, as I said, around maybe 8 legitimate transactions getting blocked for every 1 actually fraudulent transactions, some banks are as high as 13 to 1. 13 real, legitimate, normal transactions getting blocked to block 1 fraud is expensive. It's very expensive, but from the bank's perspective, it's generally worth it because blocking 1 fraud could cost them, say, $100 if it's a $100 transaction. Blocking 13 legitimate transactions at $100, they would get pennies on that transaction, maybe a couple of dollars if they're charging well enough. The incentives just aren't aligned to allow legitimate transactions through nearly as much as they are to block fraudulent transactions at whatever the cost. So what can a merchant do? What can a merchant do to get these transactions to recover, to be better presented to the banks, to have them understand that these are transactions that should be allowed through? Well, failed payments are not all the same, and they shouldn't be treated as such. Certainly, several merchants that we've spoken to in the past have very simple strategies, something like, oh, well, I'm just going to retry my declines every day for 30 days, or I'll try them every 5 days for 7 attempts. And you'll certainly get some recovery on that, but it is a very rudimentary approach when some precision is really required to get the best results. Just very simply, a insufficient funds transaction is not going to recover the same way that a do not honor transaction will. Insufficient funds is all about what bank did this come from? What type of card is it? When is this person likely to have money in their account again? Whereas a do not honor transaction is how can this transaction be better presented to the bank for them to understand and appreciate that this isn't a fraudulent transaction. This is a normal recurring transaction that a customer is wanting to see continue. Here it is. Transactions also need to be presented in expected ways. What that means is if a customer signs up at, let's say, 2 in the afternoon on the 1st of the month, well, it would probably be best to try and continue that cycle moving forward. Bill them at 2 o'clock in the afternoon every 1st of the month. Keep that cadence going, and if a bank respected that transaction the first time it saw it and understood that this is a good transaction, keep that cadence going. Keep it going so that you don't make a bank misinterpret the recurring transaction. Also, recovery dollars need to be prioritized. If you have 5 declined customers and 4 declined at a price point of $10 and 1 declined at a price point of $50, well, that 1 customer at $50 is not only worth more than the other 4 customers, but it's also probably better to have 1 customer reactivated than 4 because you'll have less customer service noise, probably less COGS involved in keeping that customer going. So focusing on what really matters is very important. And lastly, retry attempts really need to be managed. So the Visa MasterCard regulations say very specifically that 15 reattempts are allowed over 30 days after a declined transaction in order to try and recover that declined customer. While that is in spec and best practices according to Visa MasterCard, there is a problem hidden in that if you were to try that, you would see that while you would get decent recovery, you would probably see lower approval rates over time on your merchant account. It might take a long period of time. It might take 6, 9, 12 months for it to happen. But in all likelihood, your approval rate will go down over time. It's because the ecosystem tends to be self-reinforcing. And what that means is if you're passing through 15 transactions or 15 reattempts for every declined transaction, and a lot of those are themselves being declined as well, well, you are lowering your approval rate for your merchant account overall. What happens when you do that is banks will look at that, and issuer process will look at that and say, well, this merchant seems to be passing through a lot of transactions that are declining. Maybe I want to treat them a little bit less favorably because they seem to be passing through a lot of transactions that I'm blocking for some reason. And so I will block even more. It has certainly happened where we've seen merchants fall from an 85% approval rate to a 75, to a 60, to even sub 50% approval rate on the merchant account before. It is a huge problem for any merchant once your approval rate starts falling. And while recovery is very important, your overall merchant account health is even more important. And so, yes, you can do reattempts on declined customers, but you want to be selective and intelligent on how you want to distribute those valuable, limited resources of retries. So what are the benefits of using an artificial intelligence approach for this sort of problem? Well, first and foremost, an AI acts silently behind the scenes, so customers never know there was even a problem with their payments. We try and prioritize getting a recovery as quickly as possible, which means that the customer retains their service with as little or no disruption in any noticeable fashion. Also, there's hundreds of reasons why a payment may fail. We went over a couple earlier, but anyone who's ever looked at a gateway response code list knows that you are likely to see hundreds of different reasons why a transaction gets declined. Going through those and trying to understand how to best recover them is certainly a doable task, but it's exactly what AI specializes in. It's feed me a lot of data and I will find the patterns there that you didn't even know existed, and I will know how to better handle that. There are so many permutations of what time do you want to retry, what day do you want to retry, what other parameters do you want to send in the transaction to get it to recover, that if you were to set up a rules-based system, again, you would see some performance from that, but not nearly as much as an artificial intelligence would, because that's exactly what it's fine-tuned to do. It's to find the hidden correlations in the data. So not all AI are created equal. This is certainly a given for anyone who works with AI models often, but it has to be trained on very specific information. You have to understand how to use the hyperparameters that you have available. You want to understand how much data do I have. Generally, the more data you have, the better your AI model is going to do. But as I say at the end here, remember, garbage in, garbage out. You have to make sure that the data that you are applying to these models are correlated and are strongly correlated and have the effect, which means that, as we do here at FlexPay, we generally have models built specifically for each response code. A insufficient funds transaction is going to have a very different recovery process than a do not honor, than it will a generic bank decline. Understanding these differences are knowable, and it could be done by a very sophisticated rules-based system. But again, it's exactly what AI was designed for. It's all about understanding the correlations that exist in the data, beyond what we will be able to see on our own. Now, AI-powered invisible recovery at FlexPay. So here we have machine learning models that decide when and how to retry transactions. What that means is each transaction is looked at on its own and also as part of the customer sort of journey in that decline process. What was the reason for this decline? Has it been the same reason throughout? What were the past retries we've done? What day, what time did we try them? How best can we try it next? Is it worth retrying next? As I had said previously, not all retries are worth doing. You shouldn't go to 15 retries for every single decline. Maybe this $25 decline is worth 6 attempts. If it had insufficient funds, well, maybe it's worth 8 reattempts instead, because insufficient funds is more likely to recover than most other response codes. We also use fuzzy logic to help decide, as I said, what is worth retrying and how many retries should get. Fuzzy logic is really designed exactly for this. It helps fine-tune and hone in on what is the precise measure of the distribution of retries that we should be applying. Optimizations of retries per merchant account. So as I said, the overall approval rate for your merchant account gets monitored and gets adjusted and taken into consideration when fraud scores are being looked at. So optimizing the retries on a merchant account level is critically important. You can't paint all merchants or even all merchant accounts within a merchant with the same brush. And finally, it requires an overarching industry knowledge of best practices, regulations, and requirements. The Visa and MasterCard regulations are quite dense. There's a lot of information there, but it largely impacts your merchant account in ways that may not always be obvious. Just one quick example is the MCC code that your merchant account is opened under has a profound impact on the approval rate and recovery rate for your transactions. What is your MCC code? What effect does it have? Well, that comes from both knowing your own business, but also having a lot of data. If you have a lot of data from a lot of different MCC codes, you can get a better idea of, well, how should I position my business? How should I position what it is that I'm doing in order to have more favorable results in the end? So what are the next steps for you as a merchant? Well, certainly the first thing you have to do is understand how big of a problem is this. How many failed payments am I seeing? What is my failed payment rate? And what is my recovery rate off of that? How many customers are you losing every month because of payment issues? Is it mostly because of insufficient funds? Is it mostly because of false declines? Is it mostly because of hard declines? Each sort of additional piece of information that you add to that will help uncover what your next steps should be. And finally, and most importantly, finding a dedicated solution to solve this problem is absolutely critically important. We really believe that this is a huge problem for merchants, and I personally encourage everyone to find any provider that can help with this. I believe our solution is the best. I've seen our models and I've worked on them for a long time, and we have some clever design ideas that have been implemented well above and beyond just taking in payment information. But without a doubt, every merchant out there can benefit from having some sort of service to help with recovery outside, above and beyond any sort of system that they might have in place on their own. So that's my presentation for today. I'll take a look to see if there are any questions here. All right, so I see our company does experience failed payments and we have an in-house system to resubmit these payments. Can you please explain why AI can deliver better results? Yes, absolutely. So AI is specifically geared to, as I said, find better correlations with data than any person can find on their own. It's specifically geared to understand what is it that's going on with this data, where are the opportunities for recovery. If you have a rules-based system, first of all, it would take dozens of rules to be able to handle everything. You want to match things by response code. You want to match things by the date it declined. You want to match things by how many times has it been reattempted so far, and you want to match it on what bank did it come from, what was the bin. You want to have rules that fall in trees underneath all of those. That's going to be very difficult to manage and is going to be difficult to optimize over time. It's going to take a lot of data, and it's not going to find all of the, just simply the correlations of where the opportunities lie. If you have a bin that you've never seen before, what happens then? It happens all the time that there are bins that there is sparse data for, that it's from a bank you've never seen before. Even more problematic is 8-digit bins are now being rolled out. 8-digit bins are going to be the new standard moving forward, which means that there's going to be even less data for every bin on its own. A machine learning model handles that with ease. We have algorithms designed specifically for grouping like performing bins together and treating them similarly. Doing that on your own, especially without having the billions of transactions behind it like we do, is going to be difficult, and it's not going to yield as best results as you might see using a system like ours. So I hope that answers your question, and if you have any other questions, let me know. But I think that wraps it up for our webinar for today.